Want help to grow your business? Download Bryn, the world's first business advisor in your pocket. To find out more, visit bryn.ai or search the App Store today.
Hello and welcome to Empire Builders. Today we're talking property and we're trying to work out how to get the best property investing strategy that will give you the most profit for the least amount of risk. And joining me today is Anthony Bell, CEO of Bell Partners Accountants. Good to see you, Anthony.
G'day, Chris. How are you?
It's always good speaking to an accountant because, especially when it comes to investing, because there's always the risk side. Like we want to look on the positive, but at the same time we want to make sure we're not taking too much risk. So maybe for the viewers to start with, do you want to give them a bit of your kind of background?
Sure. I'm head of strategy for business growth and investment at Bell Partners Chartered Accountants in Sydney. We're actually now an Australian firm, and our firm generally specialises in not just the recording of history, but also in the making of history. So we're very much proactive in the areas of developing business plans and developing investment strategies, and then staying with our client base all the way through that while they achieve it, and advising on those things.
And you're very property focused, aren't you? Because you've got stacks of real estate agents on the books, and you deal with some of the biggest firms and the most innovative firms in Australia. Yeah,
we're general practitioners by nature, but definitely property services is one of our bigger sections in the office. Our private client base they like that because our advice and knowledge doesn't just come from what the textbooks say. They actually come from what's happening out there real time in the market at anyone, and the information that comes back to us is just astounding.
Because accountants have always been pro-property anyway, because it's nice and kind of safe and solid. But again, quite often they're pretty conservative and they're not entrepreneurial, so it's having a bit of a balance, isn't it?
Yeah, I was told years ago, accountants' definition is poor people trying to tell rich people how to get richer. And so when I look at that, the staid and technical side of property has always been an attractive one for accountants to advise on. But by the same token too, some of the richest people in Australia have developed their portfolios based on a high emphasis on property, and we tend to like that as well.
And they always say when you go around the BIW rich lists all around the world, then you look at the people that have made their money or hold their money in property, and it's a massive proportion, isn't it?
Yeah, it is. And I think there's a real reason why the banks will still give up to 95% of the value of a very good property, and that's because they don't expect the swings to be quite as high. A share portfolio, even if it's blue chip, will be more of a 60-40 LVR. So there's a very good reason why property is seen as staid and a great place to create wealth. But I want to touch on the fact that the beautiful thing about property is that you don't have to pick up a financial review every day and find out what your property is worth, which you do have to do on the stock market, and that brings a bit of investor agitation as well. So a smart long-term play on property is generally the ticket.
Yeah. Now, I was always told in the early days of trying to pick advisors, a great question to ask an advisor as well, if it's so good, do you invest as well? So are you a textbook investor, or are you actually doing it yourself and practicing what you preach?
Yeah, I'm practicing what I preach, Chris. My mum was mad on property and the importance, sort of that, sort of when my sister and I were growing up. And I think the first property I bought was in 1997. And again, the same plan was a long-term view on holding that. Now, I always say this, and it's much to the ire of some of the real estate agents I represent, you should never sell property. Hold it, but the caveat on that statement is to never sell property that you don't live in, meaning your investor nature should just keep on rolling on and creating a strategy that as equity starts to lift and yield starts to lift and you start to move from negative gear perhaps to positive gear, it's a great telltale sign to keep on rolling it over and then buy another property to continue the rage.
Yeah, so when people say to me sometimes, it's really good now in positive gear, and they're thinking it kind of a boasting thing, and I'm saying, I couldn't sleep with that. That means that I'm under leveraged and I should actually go and do something.
Well, yeah, and it's also telling you though that your theorem actually did work. So you bought a property, it went from neg to positive, but it's telling you that this is now distributable income, it's residual income, and you should be using that to keep on growing your portfolio. I mean, in Australia alone, if I look at the last 50 years, property has doubled itself every 10 for that period. So history is actually also supporting that as well.
Yeah, so if it works, keep on repeating like McDonald's. Now, we're going to have a whole bunch of different viewers out there. We're going to have CEOs, we're going to have first home buyers, people who are employees, people that are self-employed. What's the general starting point for trying to develop a strategy? And I guess maybe one of the things to add in, there there isn't one single strategy that's right for everyone, is there?
No, there's not. And it said that it goes to your personal characteristics of your income, the certainty of that income, perhaps whether you're self-employed or the industry you're in, and the safety of the future sources. But I'll go back to one of the great mentors of mine, John McGrath, told me in the early 90s, that if you want to get into property, first thing you should do is free up your Saturday mornings, because it's important to walk the streets and go and see, touch and feel. And another great suggestion I got from him was, try and invest in property that you can drive by. And the intent behind that one is it means you might know a little bit about the area, the pros and cons, what a tenant may want from that property, the good areas, the good streets, the things that work for you and the things that certainly don't.
Yeah, because when you get on later on, then ideally you want to kind of go for where the biggest capital growth is and the rest of it. But if you're investing interstate or overseas, you're not going to have a clue what the average person lives in. And so even if you're not in the best place in the world, but at least you understand it, you're not going to probably overpay or buy the wrong kind of property.
I think so. I think the common threads of what makes great property work all over the world. There's no secret mission book on that one. And you mentioned the suggestion of capital growth has been my number one most important part. You shouldn't be in property just for yield. I hear all the time that properties, they're yielding so well and there's actually a profit in them, but they're not going to grow at all into the future. So I'm off that tangent immediately for two reasons. One, it's a not beautiful nest egg investment. We want capital growth. The tax rate's lower on capital growth than it is on yield. But most importantly, the issue that comes is that the portfolio can't keep growing unless the capital base is growing as well. So it's really important to think of capital growth first, but then you've got to think about the affordability, and then that's where the tenant comes in, the yield comes in. Now, negative gearing is not a bad thing, because I often find there's a real nexus with capital growth and unfortunately neg gearing. So you've got to make sure then your supplementary income is enough to just keep supporting that.
And again, the tax rulings in Australia are going to change. We've got people from I think 150 different countries around the world. They're all going to have different things, and so property's got to stand up by itself, whether there's positive or negative tax consequences.
Correct. Whether you buy in the New York market, the London market, in the Southeast Asian market, some of the beautiful properties that sort of moving around the Hong Kong and Singapore areas, still have the same rules of thumb. I say go to the history and see where capital growth has been. Look into the projections and the factors which should lead that capital growth to continue. And then the scarcity of great property will also mean that there's a demand, and therefore where demand is high, yield usually follows it.
Now, I started investing in the 90s as well, similar to you, and there's no books, there's no TV programs, no seminars, no internet. What resources are around for people these days?
Look, the one thing that I say is you can get on the net and get tons of information for free and be available. The how-tos are everywhere. But with that also comes an influx of articles that are posted or opinions that are put online that may not necessarily be correct. So one of the things I always do is I say find a rich friend. Find somebody else who's invested in property and go and ask them. Find out what they've done. Find out what they suggested you do on top of all the standard research you do. But again, you've got to walk the streets. You've got to press the flesh of property and feel it and see it. And there's no fast way to just get it right every time. And so, I always say put the time in, do the homework, and that's going to mitigate the risk.
Now, you said there is a lot of free information out there and it's great, but again, some people say, well, you get what you pay for, so if it's free, then that's the value you get. When do you need to try and step up to get paid advisors, and is there almost any limit to how much you should pay an advisor if they're that good?
Yeah, and like I said, for $1 spent, you should make a couple of bucks out of that as well. And this is where it does get a little bit tricky. And then when we're getting past just the short-term residential chance to actually buy property, this is what really comes to finding a really good advisor, a party who's got proven track record, who's got the right clientele, a clientele that's similar to yourself, and also too who's been around for a while, not just somebody who develops a quick website and says I can help you buy property. You're looking for that person, and you're asking the same questions you're asking me, which is, well, what do you do? What do you buy? What are your influences to qualify that person? But as the world shifts and opportunity cost becomes more important, I then say that it does make perfect sense to find an advisor to go and find you the right property while you're continuing what you do for a living at a rate per hour that actually will justify it.
So if your advisor's got a bit of grey hair or a bit of balding hair because they've got lots of experience, then that can be a great thing.
Could be okay, on the start there, Chris, but by the same token too, again, the track record is everything. So young, older, indifferent, I always go to any advisor in any specific area. I want to know what they're up to, and I also want to see that they're busy, meaning that other people are using them too.
Yep. So you started looking at properties, you've read some books, been on the internet, you're then looking at advisors. What are the next places to go from there?
I think the next place to go there is go and see your bank and find out exactly what you can afford and what they're prepared to back you in as well. So a lot of people actually hit that move. They're looking in the wrong market, and they then find a place that they think they can afford. They go and see their bank and they're told, no, you can't. You're hundreds of thousands of dollars out. So you do that relationship work at the front and go and actually get pre-approved finance. So you actually know where you're actually sitting on. Really important with the bank to start well, and also because then you hopefully will rely on that bank to continue with you next time you knock on their door and say, look, I've done property number 1. I now wish to move to property number 2 or 3 or 4. And the bank looks at your record and says, well, this person has made every single payment. It's been a pleasure to deal with. They haven't been an issue. And you'll find that then the approval is easy to get, but you'll also find the cost of your money will also too be in the lower quadrant as well.
So quite often what we find is a lot of amateur investors literally just jump in straight away, go out and look at the first property and go and buy it. But the really good ones, they'll probably work for 3, 6, maybe even 9 or 12 months, do all the research, find all the facts and figures, and then make sure they make a better investment rather than jumping in quick. Now we're going to have lots more tips and ideas for you. We'll take a short break, but we'll be back soon. Welcome back to Empire Builders. Joining me today is Anthony Bell, CEO of Bell Partners Accountants. We're talking property and how to build a strategy. So let's say we've got a bit of strategy kind of sorted out. Now we need to think of, well, do we invest in our home state? Do we invest interstate, or maybe do we even go overseas? What are some of the pros and cons we need to think about?
Well, the issue is the further you go abroad, probably the least amount of information you're really going to have on that property. And if something sounds too good to be true, I always work on the basis that it probably is. I got a client sent through a brief to say he wanted to buy property in Athens. He said he can buy a 2-bedroom unit. Sort of around equal to about 80 square metres in the Australian vernacular, and he said he can buy that for €60,000. And I thought, wow, that sounds cheap. I mean, it's coming in around $100,000 Australian. But then that's why they made that movie, The Castle. I mean, we talked about properties being worth almost what they were when we bought them, and so it's not just about the cheapest buy. It's got to be about where that point is on the life cycle of a property. So the further you go abroad, Chris, the biggest issue you have is that you probably will be relying on a lot more speculative information than you will on things that come through to you. And that's why I'd say very important to make sure you've got the right advice from an external source if you're choosing to do that. But coming back to your home state, yeah, really important. You can understand that, but the issue comes, and particularly right now, the Sydney property market has been really, really high. So if I give an example to people all around the world, that there are other pockets of Sydney that are outside the Sydney property market that do represent better investment buying and better value for money. The Brisbane market, for argument's sake, has got a lot of interest in it right now. It's competitively priced, but the question still comes to remain is it's not just about what you can buy your 2-bedroom unit for with a lock-up garage, balcony size, precinct, cafe society, etc. that's there, and local infrastructure. It's what is actually going to happen with that property into the future, and that is where the real knowledge needs to take place.
And it's trying to understand what the locals will buy, because in one place you'd buy a unit, another place you'd buy a house, townhouse and whatever else, which we'll go into later. But also another thing is quite often when you speak to developers of property, they always joke, if you can't sell it to a local, sell it to a foreigner. Because they haven't got a clue.
That's right. And we do know our FIRB rules do make it easy for foreigners to buy, particularly for off-the-plan type sales. But by the same token too, that question or that challenge that you posed before, that it should be sellable to a local, because the person buying the property should think that at some stage, if they do want to exit, that they are going to have to get out of the property, and they are going to have a relatively high form of demand if there any chance of making some sort of capital gain.
Because I was over in Asia about a year ago, and they were selling some Sydney property, and they were saying,
to continue enjoying this presentation, download Bryn, the world's first business advisor in your pocket. To find out more, visit bryn.ai or search the App Store today.